Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the investment thesis focused on data center energy and physical infrastructure.
It's a fascinating one. Very concentrated.
It is, and the thesis statement is incredibly precise. The whole strategy is betting that markets are just inefficient,
Right.
that they're failing to price the convergence of a higher for longer macro paradigm and the massive capex required for the physical AI revolution, and that this creates a rare opportunity in overlooked hard assets that offer both, inflation protection and explosive growth potential.
And that thesis really does frame the entire conversation. We're looking squarely at the physical reality of this AI boom. I mean, this isn't about code or algorithms.
No.
It's about concrete, steel, and megawatts.
Mm.
The whole portfolio is designed to withstand market volatility and, more importantly, technological disruption by owning the foundational stuff. The energy, the logistics, the raw materials, the infrastructure everyone else has to rely on.
Okay, so let's unpack that. If the bet is on the physical world, we have to start with pillar one, infrastructure dominance. The sources we looked at suggest the AI boom isn't just software. It's a physical, capital-intensive revolution.
A lot like building the original railroads.
Exactly. It's like Moore's Law is suddenly hitting a physical roadblock, and that roadblock is the grid.
That's absolutely right. The growth of AI is really just becoming a massive power and cooling problem. So the central focus here is on power water supply. We're seeing this seismic shift.
How so?
Well, the newest data centers, especially for training these huge models, need 5 to 10 times more power than the last generation of facilities.
5 to 10 times. That's an incredible jump.
It is, and the numbers are just, well, they're staggering. Analysts are now projecting over $1 trillion in new data center development in North America alone.
$1 trillion. The question isn't just the sheer size of that capex, but if it's even fundable in a higher for longer world. And this is where the strategy seems to find its edge. Natural gas is called the unsung hero here.
And probably the cheapest AI exposure you can find today.
Right.
And that belief, it leads to a very specific, and I mean heavily concentrated, land-based strategy. The portfolio has put nearly 30% of its liquid net worth into just two companies.
Two companies, LandBridge and Texas Pacific Land, LB and TPL.
That's them. Now, that level of concentration, it requires a massive amount of conviction.
I have to push back on that a bit. 30% into two land companies in the Permian. That's hyper-concentrated. What's the justification beyond just cheap gas and water? Is there a political risk, regulatory risk?
It's a calculated bet. It's
Yep.
a bet on assets that can't be disrupted and their unique legal position. The concentration is justified because you have this perfect convergence of three things in the Permian. First, yes, dirt cheap natural gas.
Which means competitive power generation.
Exactly. Second, ample water, which you absolutely need for cooling these mega-scale facilities. But the third piece, and this is the most critical one, is that TPL and LB are surface owners.
Meaning they control the actual ground the buildings sit on?
Precisely. So unlike a typical energy investor, these landowners profit not just from oil and gas royalties, but from surface royalties and from the booming water and commercial sectors that pop up around these things. So when a company wants to build a 5-gigawatt data center campus,
Which is what, as much power as New York City?
as much as New York City, they have to lease the land from LandBridge or TPL. So the landowners are collecting royalties on every single part of that development. It creates all these layers of non-disruptible revenue that goes up with inflation. You're basically turning dirt into a key component of the digital economy.
That makes the transition to Pillar 2 pretty seamless. If Pillar 1 is securing the land and fuel, Pillar 2 is about getting that fuel to the machine and making sure the machine doesn't melt. The electrical grid and mechanical engineering bottlenecks.
The scale is the real problem. You can't just plug something that needs a city's worth of power into an existing substation. We need trillions in new capital expenditure just for grid modernization.
Really?
And the market sees the demand, I think, but not the friction. The sources point out that interconnection queues, just the process of getting new power hooked into the grid, can be up to 7 years long.
7 years. I mean, that's an eternity in the tech world. But for an infrastructure investor, a 7-year queue sounds like guarantee revenue.
That's the key insight. That huge backlog creates non-competitive pricing and guaranteed long-term revenue for these mission-critical service providers. You have to look at a company like Comfort Systems USA, ticker FAX.
Right.
They are the essential backbone for data centers. They do the complex mechanical and electrical work. We're talking sophisticated HVAC, modular cooling, immersion cooling, everything you need to stop these high-density racks from overheating.
And the proof is in their backlog, isn't it?
It's absolutely stunning. FX has a backlog of nearly $7 billion. That is a massive indicator of long-term demand visibility, no matter what the economy does month to month. They're installing the stuff inside the buildings.
And then on the outside, you have Quanta Services, PWR, tackling the electrical infrastructure.
Correct. Quanta specializes in the huge power transmission and distribution lines you need to carry all that new power from the generator to the data center campus. They are just set to benefit massively from this AI build-out.
Okay, moving to pillar 3. Power generation, fuel, and the nuclear catalysts. Since gas is the primary fuel, we need to get it there reliably.
We do. And midstream assets, the pipelines and processing facilities, they're the foundation for moving that natural gas. A top pick here is Antero Midstream AM. It's a high-yield holding because it has this resilient fixed-fee business model.
And that's important because
It means their revenue relies purely on the volume of gas moving through their pipes, not on the volatile price of the gas itself. So that fixed-fee structure protects them from price swings, but they still get the upside from the volume growth driven by AI.
So the infrastructure is insulated from the commodities volatility. Okay, so from the pipes to the power plant itself, the actual machinery, that's where Caterpillar, CAT, comes in.
Caterpillar is identified in the sources as a full-blown winner of the AI revolution. They're the ones supplying the massive engines for both prime power generation, so the main source of electricity, and the essential backup systems.
And these data centers need both.
Absolutely. When a facility needs 5 gigawatts, they're ordering engines by the dozens, maybe hundreds. The demand is strong, it's sticky, and it covers both prime and backup power.
That handles the immediate power needs. But looking out a decade, if AI demand just keeps soaring, renewables aren't going to cut it for baseload. That brings us to the nuclear renaissance.
And what's really fascinating here is the long-term sort of backbone play in nuclear. We're citing Centrus Energy Corp, LEU. Centrus is all about enriching LEU,
ALEB.
high-assay, low-enriched uranium. It's the specific next-gen fuel you need for small modular reactors, SMRs. SMRs are smaller, they're safer, and they can be deployed much faster than traditional nuclear plants, right where you need the power.
And why Centrus specifically?
Because they're the only company in the U.S. right now with an NRC license to produce this HAU material. So they have this direct exposure to a projected, $6.2 billion market by 2035? It gives them a near monopolistic position in fueling the very thing that will close the power gap down the road.
A powerful long-term play. But let's shift focus to pillar 4, which is all about macro timing, the cyclical value recovery. The portfolio is about 50% exposed to cyclicals, industrials, energy, transport.
The thinking here is that the high-growth areas, like big tech, might struggle. They face extreme concentration risk, even if AI adoption keeps going. So the strategy is to capitalize on industries that have been, severely undervalued but are set to boom in a big infrastructure and energy cycle.
And this leads to some very specific ultra-cyclical transportation bets. Old Dominion Freight Line, ODFL, is a key holding. Why them?
ODFL is expected to potentially double in a cyclical recovery because it's America's most efficient less-than-truckload company, LTL. They move smaller shipments, which demands extreme efficiency to make a profit. So when the economy recovers, ODFL's pricing power and operational excellence let them scale incredibly fast. Union Pacific, UNP, the railroad, is another core holding expected to outperform when industrial sentiment turns.
In tying this recovery directly back to the inflation thesis, we get to Range Resources, ROC. This is a pure-play natural gas producer.
Range is pure leverage. The estimate is that RRC's value could double if Henry Hub gas prices get to $6 or higher. And that lines up perfectly with the central inflation thesis. Energy stocks have historically been the best assets to own when inflation is rising.
Because their costs stay relatively fixed.
Exactly. While the price of what they sell just goes up and up, this is where the macro view really connects to the portfolio's growth potential.
So if we synthesize this, the final verdict, the strategy is making a very clear choice to avoid tech stocks. It's avoiding semiconductors, avoiding anything that faces that rapid disruption risk.
Right. It's betting on the non-disruptible physical infrastructure instead. The whole thing is structurally aligned with long-term inflation, maybe a base of 4%, leading to high single-digit nominal GDP growth.
Yeah.
We're betting on the foundation, not the software on top of it.
But let's talk about the risks directly. Does that justification really outweigh the inherent risks? We mentioned the aggressive concentration, 30% in just two land companies. It's highly sensitive to higher for longer rates,
Hmm.
which, can crush debt-heavy cyclicals. And the whole thesis hinges on a cyclical growth bottom actually showing up soon.
Those risks are absolutely real. They're the core stress test. I mean, if rates stay high forever, the debt burden on these companies gets painful. And if the cyclical bottom never comes, well, these cheap assets just stay cheap. But the strategy is really designed to thrive in one specific scenario that sort of nullifies those risks.
Which is what.
It's the final provocative thought. It's about a paradigm shift. If sustained higher inflation, called financial repression, is implicitly embraced by policymakers as a way to inflate away the massive national debt.
So if Washington just decides to let inflation run hot at 4% or more to get rid of its debt problem.
Exactly. Then the whole investment landscape changes. The real value of the fixed debt on the books of these asset-heavy companies, the railroads, the pipelines, TPL, it starts to decline rapidly. At the very same time, their cash flows and the nominal price of the physical resources they own will rise dramatically. And that is what positions this hard asset bet for a paradigm shift where debt gets cheapened and real resources appreciate. It's a necessary hedge for you, the listener, to consider.
A truly fascinating thesis. It ties the physical constraints of AI directly to the highest level macroeconomic decisions coming out of Washington. Thank you for walking us through this deep dive.
Risk defined, portfolio protected.